We're jumping straight into Sidus Space today. Everyone is watching the recent price action. I mean, these explosive surges.
Oh, absolutely.
The stock is up anywhere from, what, 250 to 470% over the last month. But for serious investors, the real story isn't just the volatility.
Exactly. The core catalyst here is a massive strategic pivot. They're moving away from, low-margin commercial work and going all in on the defense sector.
Right.
And the materialization of that $151 billion contract opportunity, backed by some big capital raises, suggests this is a classic high-stakes turnaround play.
A very high-stakes one.
You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us walking through this complex narrative.
Yeah, we're really glad to have you. If you're enjoying the show, make sure to subscribe and hit that like button. It really helps the channel out.
It does.
And definitely let us know in the comments which stock you want us to simplify next.
All right, let's look at the bull and bear case for Sidus Space right now.
Let's do it.
The narrative is it's completely polarized. On one side, you have this massive, almost unbelievable upside from these huge defense contracts.
And on the other.
On the other, you have the immediate, stark reality of heavy losses, rapid cash burn, and, well, significant shareholder dilution.
Okay, let's start by looking at the bullish foundation then. And it really all revolves around one gigantic number.
Yep.
$151 billion.
Right.
That is the contract ceiling for the Missile Defense Agency's SHIELD IDIQ program.
And that IDQ part, that's indefinite, deliver indefinite quantity.
Okay.
That technical name is important, but what's really crucial here is the context of that contract award.
Okay.
Sidus Space secured a placement on this vehicle, which in the defense world is often called a Golden Dome program. The $151 billion is the total funding pool available through 2035.
So why is just being on the list so critical? What does that really mean?
It positions the company as a pre-qualified vendor for the entire life of the program. Think of it like this. They've already passed the years-long background check and security clearance just to get a seat at the bidding table.
So they're in the room.
They're in the room. They aren't guaranteed dinner, but they no longer have to wait in line. They can now directly compete for specific, multi-year, and often non-competitive task orders. That access itself creates a huge barrier to entry for anybody else.
And here's where it gets really interesting. Because, access alone isn't enough. You actually need a competitive edge to win those task orders.
Of course.
And it seems like Sidus Space's edge isn't just one product. It's their whole vertical integration model. They're positioning themselves as a full space-as-a-service provider.
That vertical integration is the strategic moat. It starts with their proprietary LizzieSat satellites, which are smaller, more agile spacecraft.
Right, the small sats.
And crucially, they've integrated a proprietary AI and edge computing stack, which they call Orlaith and FeatherEdge hardware, directly onto those satellites.
And then they build them in their own 35,000 square foot facility down in Florida.
Yeah.
So why does building it all in-house matter so much to, say, the Department of Defense?
Well, if you connect this to the bigger picture, it matters because defense clients prioritize two things above all else: speed and security.
Okay.
Vertical integration lets them cut out like 3 or 4 layers of subcontractors who typically slow everything down for the big legacy prime contractors. They control the entire stack.
From the manufacturing floor.
To the software interface. This gives them dramatically faster turnaround times for military clients who increasingly prioritize what they call responsive space technology.
So small satellites that can be built, adapted, and launched really quickly?
Exactly. It's the agile startup model, but it's tailored for the defense industrial base. And the SHIELD award, it validates not just their technology, but their whole security posture, which is absolutely essential.
And it's also worth pointing out, this isn't their only government work, right? They already have a $2 million U.S. Navy contract and a NASA subcontract for tracking space debris.
Absolutely. The smaller existing contracts provide the proof points that they can execute.
Right.
But the SHIELD award is the game changer. It validates that the core technology is ready for large-scale, long-term deployment.
This all sounds fantastic, but to capture a piece of that $151 billion pie, you need cash. You need a bridge between today's unprofitability and tomorrow's revenue.
Which brings us to the balance sheet.
The liquidity story.
The balance sheet is the most essential mitigating factor against the bear case. Management recently went to the market and they raised substantial capital.
Yeah, through 2 big recent offerings.
A $16.2 million raise and then a subsequent $25 million raise.
And we should probably pause here because these details are really critical. These raises were done at the bottom, right, at like $1.50 and $1.30 per share.
Yes, precisely. This was not cheap capital for existing shareholders, but it was absolutely essential.
So you have to put those numbers into a narrative about survival and, well, execution.
Right. At their current cash burn rate, which is about $4.7 million a quarter, the company now has approximately $37.7 million in liquidity post-raise.
So that cash provides an estimated 8+ quarters of operating runway.
They essentially bought themselves 2 years of time to execute on the SHIELD contracts before they even have to think about going back to the market again.
That runway is the key asset here, and they have more cash than debt, which is pretty rare position for a company with this kind of explosive growth strategy.
And what's equally fascinating is the institutional flow that came in with those raises.
Yeah, that's where you see the real conviction.
These offerings brought in significant institutional investors, CVI Investments and Heights Capital Management, who collectively acquired a 7.4% stake.
So that level of institutional buy-in, it suggests they aren't treating this as distress funding.
Not at all. They're viewing it as growth fuel.
Fuel needed to actually execute on the defense strategy.
They are placing a bet on management's ability to convert that contract optionality into a tangible backlog.
And from a technical perspective, the stock's huge surge means those offering prices, that 130 to 150 range, now act as very strong psychological and technical support levels.
Yep.
Investors who bought in recently know that institutional money essentially drew a line in the sand right there.
And on top of that, we can't ignore the high short interest. With around 14.7% of the tradable shares currently sold short, any sustained good news on SHIELD task orders could trigger a massive short squeeze.
Right, the actual first orders.
Yeah. High short interest can be rocket fuel when the underlying fundamentals and the contract pipeline are improving this fast.
This cash runway sounds great, but it brings us straight to the inevitable trade-off. We have the huge prize and the cash to chase it, but you just can't ignore the fact that the company is currently bleeding money.
I mean, the financials are challenging.
This is the challenger facing the financial giants.
And this raises the single most important question for any investor looking at this. Just how challenging are the financials right now?
Yeah.
And the reality is, well, it's harsh.
Yeah.
Sidus Space operates at a deeply negative EBIT margin. It's cited at around negative 676%.
Okay, walk us through what that actually means for someone listening.
It means they are massively subsidizing growth.
Yeah.
For every $1 of revenue they brought in last quarter, they burned almost $7 to produce it.
Wow.
The net loss widened to $6 million in Q3 2025. And while their strategy is all about pivoting to higher margin services in the future, Q3 revenue still declined year over year.
So this underscores that it really is a high-risk turnaround play.
It's not a stable, mature cash generator, not yet.
And that leads directly to the dilution consequence. This is the #1 concern for the bears, right? That $16 million and $25 million in cash came at the cost of some really significant shareholder dilution. We saw price drops of nearly 30% right after some of that news hit.
And this constant need for capital, because of that aggressive cash burn, is a heavy weight on the stock. That dilution risk remains very high until defense revenue actually starts hitting the income statement.
So the dilution is a feature, not a bug, of this type of strategy.
Exactly. But the second major risk is just execution. We have to emphasize that the $151 billion SHIELD IDQ is only a ceiling.
It's not guaranteed money.
It's not guaranteed revenue or guaranteed backlog.
They have a seat at the table, but they still have to win the bids.
Correct. They have to actively win and execute specific task orders against other pre-qualified vendors.
And those vendors are often the much larger, more established legacy defense primes.
Right. So if Sidus Space fails to convert the optionality of this contract into tangible multi-million-dollar revenue wins over the next, say, 12 to 18 months, the entire defense thesis collapses.
And the stock could re-rate sharply lower.
It's a huge opportunity, but it requires flawless execution against some very entrenched competition.
So what does this all mean for you, the listener, right now? It seems like everything hinges on two things: execution and timing.
That's it.
Given this massive pivot, what are the key checkpoints over the next few months that will tell us if this whole thesis is actually playing out?
The market will be laser-focused on a few things in early 2026. First up is the Q4 2025 earnings.
Expected around early March 2026.
Right. And management doesn't just need to report results. They need to provide clear, forward-looking guidance for 2026 revenue. We need concrete commentary on how that newly raised capital is being deployed to capture those shield task orders.
We're looking for that optionality to start translating into a measurable backlog.
Exactly. The moment that backlog starts building, the entire risk equation fundamentally shifts.
And on the operational side, what are the milestones that matter there?
Operational milestones are the second key factor. The launch of LizzieSat-3 is the big one. Now, the precise launch window is still a bit fluid. We've seen references to both early 2025 and early 2026, depending on partner launch schedules.
So the market will be looking for a firm date as a critical de-risking event.
Yes, the successful deployment of that asset, combined with any public announcements about initial material task order wins from the Missile Defense Agency, would be the biggest triggers for the stock going forward.
So we're watching the financial reports for backlog and the launch schedules for operational proof. The final piece of the puzzle here is the macro environment, which right now seems to be providing a pretty strong tailwind.
It absolutely is. The ongoing geopolitical tensions support robust and, frankly, increasing defense budgets globally.
And the sector itself is shifting.
The entire industry is shifting toward responsive space technology. That means fast, flexible, AI-enabled small satellites, which plays perfectly into Sidus Space's strengths.
Vertical integration, edge computing, rapid manufacturing.
The demand for their specific technology stack is aligned perfectly with the shift in defense spending priorities.
So that's the lowdown on Sidus Space for today. It's a compelling, high-tension story. You have an unprofitable tech firm making a monumental play for the defense sector's most significant contract vehicle.
And they have bought themselves 2 years of operating runway to make it happen.
If they convert that opportunity into real revenue and backlog, the reward is massive, but the execution risk is real, and the cost of dilution has been high. So think about this. The market is currently valuing the company based on its weak Q3 financials, but the institutional money is clearly buying the option on that future shield revenue.
Yeah.
For you, the question isn't just if they win task orders, but when those initial wins will translate into real quarterly revenue growth. That inflection point is the moment to watch.
That's the key.
If you haven't already, subscribe so you don't miss our next breakdown. We'll catch you on the next one.